Good morning, viewers, and welcome to the channel. My name is Shannon Rivkin. Title of today's video: Commonwealth Bank reported a rise in quarterly cash earnings of roughly 20%. Why has the stock been sold so aggressively? We obviously need to see a little bit of context here. CBA, certainly since its COVID lows, has been effectively on a straight line up, as the worst case scenario of the impact from the pandemic just never materialized. We saw, at least in the results throughout this period, have some pretty significant provisions for bad debts, and of course throughout this period we started to see those bad debts, for the most part, wrote back into the profit line, and towards here where we've got to all-time highs of around just over $110, and then this quarterly update that at least at first glance looks solid enough, but in the context of a share price that's rallied so much, the market didn't want to see any warts, and there were some warts. There were some positives, no doubt. I've cherry-picked something from the announcement that talks about their volume growth compared to the system, which does mean, for the most part, they have been taking market share in deposits, lending, and home and business lending, which is not overly surprising, but still very good to see. Certainly, the business lending as well. Really strong performance there. Of course, to the problem I was going to get to. Oh no, so I don't have it. They didn't provide actually any real data on this, but the real issue in the result, of course, was that little line about net interest margins, and what they said was that net interest margins were considerably lower, I think was the expression they used. They didn't give a number, and that's typical with what they do, but they were a little above 2% on the previous quarter, and the market's now thinking that it could be as low as 1.9%, and this reflects what is a very aggressive market at the moment for home lending. Competition is rife. We've also seen a lot of competition for fixed rate loans, which are lower margin as well. We've started to see this in some of the other results as well. So to some degree, I'm a little bit surprised that the market was caught so off guard by this. But net interest margins have been under pressure with the other three big banks as well, as that competition has been so fierce. The question is, how long is this going to last? We have started to see those fixed rate loans start to tick up in pricing, whereas the variable rates have gone the other way, which is probably the positive in the fixed rate margins has probably improved. Positive for the fixed rate margins has probably been offset a little bit by the variable rate margins, and the question is, are we going to see that trend continue? And of course, the likely trend for the RBA is talking about 2024, but 2023 and 2024, but certainly the bond market suggesting otherwise. But when are we going to see interest rates start to increase from these all-time low cash rate levels of 25 basis points? A higher interest rate environment will be very good for net interest margins for the banking sector, and that's probably what the market will need to see in the absence of a less fierce home lending market at the moment. And look, I think this is the other key thing to see here, and why it was so vulnerable to a sell-off is that the rolling PE ratio of the last 10 years. I don't know what this was. This may have had some one-offs in it, but for the most part, we've seen CBA always at a premium to the other banks, as undoubtedly the highest quality bank, kind of on almost every financial metric, but traditionally trading around that 15 times multiple, and then of course we, in this ridiculously crazy bull market that we've seen, got as high as 25 times, which is for the most part I think a 30 or 40% premium to its peers, and so even with yesterday's sell-off, an 8% sell-off, still trading around that 20 times multiple. Question is this deserved in such a competitive market for home loans as we're seeing now? The banks, over the long term, they are vulnerable to fintech competitors as well. This is not just the big four banks, eating each other's lunch. We are starting to see non-bank lenders and fintech lenders come into the market, and while at least in a a housing boom that we're in now, the numbers look very good for the banks. Should we be paying a premium when there are so many question marks into the future? I'm not so sure. Anyway, that's it for this week's video. Thanks for tuning in, and if you did like the video, please click like and subscribe, and I'll be back next week with another video.